Hi, we'd like to welcome everyone today to Smollen's Small Business Owner's Guide to Financial Relief during COVID-19 webinar. We know this has been a challenging time for a lot of small businesses. Even if your business hasn't been closed, we know that sometimes there's a need for financial relief and the options are many. Thankfully, there's a guide to stimulus packages that have come out that offer some solutions for you. And we know that it's a lot to interpret. I mean, things are changing every day. So we have a bunch of experts together today to give you some insight as to what your options are. Moderating the panel today is going to be Henry Rinder. Henry is a licensed certified public accountant in New Jersey and New York with more than 30 years of public accounting experience. He services clients in the construction, distribution, manufacturing, and legal services industries. Henry is a member of the American Institute of Certified Public Accountants, the New Jersey Society of Certified Public Accountants, the Association of Certified Fraud Examiners, and he is also a diplomat of the American Board of Forensic Accountants. We also have Tom Cole. Tom's a licensed certified public accountant in Florida, New Jersey, and more than 35 years of public accounting experience. He services clients in the construction, retail, real estate, and professional services industries. Tom is a member of the American Institute of Certified Public Accountants, the Florida Institute of Certified Public Accountants, and the New Jersey Society of Certified Public Accountants. We also have Joseph Andolino. Joe is a tax attorney with 40 years experience advising corporate taxpayers, entrepreneurs, and families about taxes and business. Joe has spent 30 of those years in corporate America with Allied Signal, Coltech Industries, Goodrich, and Halliburton. Joe has had tax leadership roles and was a decision maker at all of these organizations. Just a little bit of housekeeping for you guys today. When you're dealing with GoToWebinar, you can minimize the panel by clicking that button on the left-hand side. You can choose how you're going to listen, either by your computer speakers or you can call in by telephone under the audio selection. If you have any questions, we're also going to have some time at the end for a Q&A. I know that there are probably going to be a lot of questions. If we don't get to them today, we will be sure to have someone from the Smollen COVID Special Task Force team respond to you with answers to that. But feel free to go ahead and ask them in the chat section. You can just type your question in and hit send, and we'll be sure to try to get to them at the end. And if not, we'll answer them for follow-up. And again, your panelists for the day, and we'll let them get started.
Thank you very much, Amanda. This was wonderful, and thank you for setting it up for us and taking a lead in introducing us. I'm actually delighted to be on this webinar with my co-panelist, Tom, who over the years, we know each other for many, many years, and I have relied on Tom to give me solid tax advice on all kinds of different matters. And he serves on Smollen COVID-19 task force that was designed with an objective of monitoring all new developments from the new laws that have passed, and on the state level as well. So, we are also joined by Joe Andolino, who is also on the same Smollen COVID-19 panel. Joe is a tax attorney, again, deep knowledge, good understanding, and very, very practical advice that I get from Joe. So without any ado, let's go to the agenda. We're going to basically talk about two different programs that have been offered as part of the CARES Act, which was recently enacted. One is described as Paycheck Protection Program, the other one, Economic Injury Disaster Loan, short PPP and EIDL. We will talk about these two options primarily, but we are also open to questions, and you're going to be able to submit your questions and email your questions, and to the extent that we are not able to cover all your questions in the next half an hour or so, we'll be delighted to get back to you later with whatever we know based on what is happening right now. So could we go to the next slide? That says it all. Joe, I'm sure you got something to say about this.
Well, I mean, I think the first step, hello everybody out there, is to talk about the loan amount under the PPP. And, it's intended to provide payroll protection and payroll continuance. So in the Act, and also in the interim final rules that were promulgated on the 3rd of April, which are available to everybody, it's intended to be a payroll loan. So really the question is, how much can you get and what qualifies as payroll costs? It's compensation to employees whose principal place of residence is in the U.S. in the form of salary, wages, commissions, or similar compensation. Cash tips are the equivalent, and that's based on the employer records of past tips, or in the absence of those records, a reasonable good faith employer estimate. Payment for vacation, parental, family, medical, or sick leave, allowance for separation or dismissal, payment for the provision of employee benefits, consisting of group health care coverage, including insurance premiums, and retirement, payment of state and local taxes assessed on compensation of employees, and for an independent contractor or sole proprietor, wages, commissions, income, or net earnings from self-employment or similar compensation. And there are some exclusions. We talked about the exclusion for employees whose principal residence is outside the United States. There's an exclusion for compensation in excess of an annual salary of $100,000 as prorated. And one of the exclusions, which has proven to be controversial in the application, is federal employment taxes, which are excluded if they're withheld between February 15, 2020 and June 30, 2020, including employee and employer share of FICA, Railroad Retirement Act taxes, and income taxes required to be withheld from the employee. So then the question is, for what period do those payroll costs get counted? And the answer is also somewhat unclear. It's either the 12 months immediately prior to the day the loan is issued, or calendar year 2019. There's been a lot of confusion and debate about that, primarily because some of the commentators have said it goes each way, and the actual application seems to say calendar year 2019. My own view is that it's last 12 months. And then once you get your 12-month period or covered period, you divide by 12 and multiply by 2.5, and whichever is less, 10 million or that number, is the amount of the loan. Tom, do you want to comment? Yes.
Yeah,
Joe,
I think you. Go ahead, Henry. Sorry.
I wanted to pose the question to Joe or Tom. Joe mentioned the exclusions, and he mentioned that payroll taxes are excluded. I just wanted to clarify this area as what is excluded and what is included. And there's two pieces of it, Tom. There's a piece of qualifying the amount of loan that you are eligible for, and then there is the eligibility for forgiveness. So perhaps, Tom, maybe you can take a stab at it and give us your overview of how that should be done.
Sure. A couple of comments I wanted to make was about the actual application for the loan. What we've been telling people too is that the loan is really being governed by the SBA lender. So some are taking the 19 wages and some are taking the previous 12-month wages. So there's some controversy in the calculation. We're willing to give the bank whatever they want, okay, so that we get the loan. The other issue is the forgiveness side of it. Now, the exclusion of payroll taxes on the forgiveness side, I think, is a fluid situation that you're going to hear about in the coming days. I actually think they're excluded from your forgiveness. So, and I don't know that everybody agrees with me on that, but I think you'll see that coming in the next few days when people try to figure out how much they're going to be forgiven. So you may only get forgiven for maybe 75% of the entire loan.
Tom or Joe, could we go to the next slide, please?
Yeah, I mean, these PPP loans are available to small business as defined in the Small Business Act, and that includes independent contractors, small businesses with less than 500 employees, and there's attribution rules that have application if they're commonly controlled. You've got to count the 500 employees of all the separate entities. And then there is actually an opportunity for those small businesses with greater than 500 employees to also qualify. If they have a SIC code in the restaurant services sector, SIC code 72 restaurants, and they have less than 500 per location, that qualifies. There are also some other businesses deep in the small business definition that qualify with more than 500. I'm not familiar with exactly what they are, but if you're in there, you may qualify. And 501c3 nonprofit entities qualify even though they're not qualified as a small business entity under the Small Business Act. So churches, for example, would qualify with less than 500 employees.
Amanda, next slide. And maybe, Tom, can you address what is the specific coverage, especially one of the issues that come up a lot is we have these small clients who are independent contractors, and they may not have payroll. How do they fit into what is covered as payroll cost, employee salaries, etc.? Tom?
Yeah, we're looking at that as the net income from their Schedule C. So the Paycheck Protection Program will replace the bottom line of the Schedule C. So, and when I say Schedule C, that's your self-employment income. And we believe that we add back health insurance, your self-employed health insurance, divide by 12, multiply by 2.5, and get your maximum loan. So that will open up on April 10th, which is this Friday. So that is our next fire that we're handling.
And as the slide suggests, Tom, majority of these loans are expected to be forgiven. So can you talk about what is forgiven and what is the taxability of that event?
Sure. The loan is a tax-free forgiveness, so there will be no tax on the forgiveness of the loan. The loan has to cover payroll costs, paid sick leave, salary, health insurance premiums, rent, leases and rent that are obligations prior to February 15th. It also covers transportation, which I take to mean gasoline for your vehicle, and utility payments. What was the other thing on here that I wanted to say? These loans, you're reading that, they're 100% guaranteed. No personal guarantees, no collateral. Just go with that. Go ahead, Joe.
Yeah, excuse me. I didn't mean to interrupt. The one clarification or addition, depending on your point of view, that was made by the regulator in the interim final rules that really wasn't clear in the statute is that 75% of the spend must be for payroll costs. So going back to the point you made earlier, Tom, while you can use the proceeds for mortgage interest, rent, transportation costs, utilities, you must, in order to get forgiveness, spend 75% on payroll costs, which of course will put pressure, and the payroll costs and the spend, in order to be forgiven, must be made in the 8 weeks following the issuance of the loan. So there's going to be pressure on the spend and the pressure on the definition of what is payroll costs, most especially the point that was raised earlier about withholding taxes. So that'll be a subject that we're going to continue to monitor, but depending on the rate of withholding tax for federal income tax, one must be very, very careful if you want to maximize your forgiveness, as any borrower would, to make certain that they stay at that 75% or greater spend on payroll costs.
Joe,
right,
excellent point.
Sorry.
Can we go to the next slide, please?
I just wanted to mention the 75%. If you go less than 75%, you'll be ratably reduced on your forgiveness. So
And
we're also
we
recommending. We're also Pardon me?
I don't know about that, Tom. I'm concerned about that. I have my questions about that. I think you're ratably reduced in the next two limitations. Okay, that is the amount of payroll costs compared to the covered period than the two prior periods and the actual total wages. But I'm not sure that a 75%, a lower than 75% doesn't just wipe out your ability for forgiveness. And that's a subject we have to dig deeper on. And I'm getting this from the interim final rules that were issued on April 3rd. And looking at page 16, it says at least 75% of the PPP loan proceeds shall be used for payroll costs. For purposes of loan forgiveness, the borrower has to document the proceeds used for payroll costs in order to determine the amount of the forgiveness. So I'm personally not clear on what happens if you go under 75%.
This is an excellent point, and frankly, the fact that our experts have maybe differing view on it highlights another concern that we all have, and that is that the guidance on these laws have been coming out daily, literally daily, and we stay on top of it. But surely there is areas of uncertainty that are built into any new act, and until the guidance, whether it's regulations, temporary or proposed, or some other Treasury or IRS advice that's given as guidance is issued, we all interpret what's in the statute, and then we try to apply it to the best interest of our clients. Let's just jump into the next slide where we consider other issues. Can we go back to the previous slide, Amanda? I'm sorry. I just wanted to sort of highlight certain specific framework, the specific framework of PPP program, which is what happens if the funds are used for other purposes than payroll protection, and in those cases the funding will still stay in as a low interest loan. The principal interest is deferred for quite some time, and the interest is running at around 4%, although I think it's up to individual banks to decide the interest rate, but I believe that interest rate is not to exceed 4%. The loan limit is $10 million. As Tom mentioned already, there is no personal guarantees required. There is no collateral required as well. The maximum maturity of these loans is 10 years, although in some early narratives I've seen as short as 5. So I think it's no less than 5 and no more than 10. And we talked about exclusions in the calculations based on employees earning $100,000 or more, which, by the way, includes owners of the business. So it's not limited to just employees who are not owners. And we talked about how it's calculated. And another point I wanted to make is when you lay off your employees, you have an opportunity to rehire them after they have been already laid off, and you will still qualify, obviously, to treat the payroll that's going to be paid to those employees as qualifying payroll cost. Next slide, please.
Henry, can I just jump in here?
Yeah, of course.
Yeah, a couple of clarifications. I think the interest rate for the PPP loans has been set in interim final rules at 1%. And it's correct that the statute says up to 4%, but it's 1%. And there's a deferment of payments for 6 months, and the term is 2 years. So interest accrues in the first 6 months, but is not payable. And of course, we're only talking about that portion of the loan that is not forgiven.
Good point. Let's talk about sort of the other side of the equation, and that's the economic injury disaster loan program. And Tom, could you give a quick narrative on what those are and who qualifies?
Yeah, this is a different type of loan. This one you'll have to actually go onto the SBA site to apply for this loan. You need very limited information because it's a streamlined application now. Basically, I believe they want gross revenues and cost of sales, and I did read somewhere that they want some budgets. On the front end of that loan, they're willing to lend up to $10,000 as an emergency grant, which will not be repayable to the SBA. But that $10,000 will reduce any forgiveness that you have on the PPP loan. Interest rate is 3.75 up to 30 years. They can take collateral and personal guarantees on anything over $200,000. And that would be from any owner that's 20% or higher. Yep.
Next slide.
I may have jumped the slide.
No, it's okay. It's okay. You can continue. Here we go.
All right. Yeah. So you go over the credit score. Apparently, you can fill out this application in about 15 minutes. So all you need are your numbers available, and you can read the loans smaller than 200 don't require personal guarantees and whatnot. Now that $10,000 is not a flat $10,000, and quite frankly, I haven't seen any clients get the $10,000 yet. But the smaller your loan, the more than likely your advance is going to be smaller on the $10,000. And whether you're approved or not for the loan, you do not have to pay it back.
Next slide, please. So I'm going to just stop here for a second because Tom or Joe, if you could describe under EIDL, what is the purpose of the EIDL loan? What is it supposed to be funding? And what do we know what we have to show that the company actually has a emergency need for this type of funding? So Joe, Tom, who would like to pick that up?
Well, I don't think the need is expressly shown anywhere. They're just going to give you a credit check. You're going to give them your gross revenue and cost of sales. They are going to offer you a loan. You're not requesting a loan. So we go on for the application. I can't say I want $100,000. I'm going to give them my numbers, just the numbers from my sales and my cost of goods sold, and they're going to come back with an offer of a loan to me. So it's not like I can just go in and ask what I want. They're going to offer it, and that's where you'll be.
And Tom, there is no opportunity to make an argument that if they offer you $100,000, you actually need $300,000. I believe you'll have an argument once they come back with the offer. I believe you can come back and say, no, I need more. This is why I need more. Joe, anything to supplement the conversation on the EIDL loans?
No, the only thing I would say is the question I've gotten most is, can I apply for both PPP and EIDL? And the answer is clearly yes, you can. And as Tom said, the only consequence is that the $10,000 grant under EIDL comes off the forgiveness amount of the PPP loan.
And gentlemen, isn't my understanding correct that if you apply, the expectation is that you get the $10,000 that Tom mentioned, no matter what?
It's up to 10,000, Henry. It's not a full 10,000. It could be 10,000. Right? It could be less. Yeah.
Yeah, because the news media made it sound like it's you apply, you get $10,000.
Right. And the other thing I want to mention about, the piggybacking loans or the doubling up of the loans is that you can't pay expenses. You can't have an idle loan and use it for payroll costs if you have a PPP loan that you're covering with payroll costs. You have a duplication of expenses there. What we've been recommending is actually putting in separate bank accounts and using your funds for the prescribed uses, which will probably need some shepherding. The idle loan you can actually use for capital, supply chain stuff, and you can keep it away from payroll during your PPP period. So you have to be very careful on these things going out.
Excellent point, Tom. Excellent point. So on the slide right now, we actually have the links to the specific areas on the SBA side that would allow you to either request a form for the PPP program or EIDL program. Although it is my understanding, unlike the economic injury disaster loan, the Paycheck Protection Program loans are handled by banks, and we have a significant number of clients who have already applied for this particular program. Tom, can you speak to that?
Sure. We've had several applications at several different banks, and Wells Fargo, I think, has already stopped their program unless they picked it up again. Different banks have been asking for different information. So we've been rather nimble with what kind of payroll information we're giving them. Some of them are demanding the 2019 information. Some are going by the letter of the law. And as Joe had mentioned, we believe it's the year ending March 31st, basically, is what we should be using. But if the bank's not accepting it, we are being very flexible getting the 19 information because we want our clients to get these loans.
Next slide, please. Well, we actually are nearing the conclusion of our webinar. We have a few minutes left. So Amanda, do we have any questions from the audience?
Yeah, so one of the questions that came through, which was an excellent question, was if healthcare costs and retirement costs and those kind of things, how they work in application to both the loans between the PPP and the EIDL loan, and when can you use those? And if your contribution to retirement was a set amount last year, can you increase that this year to still be eligible for those amounts?
Let me try to handle that, Jamie. The answer is yes for PPP loans. Retirement benefits count as payroll costs to the extent they're funded by the employer. So if we're talking about 401k contributions or contributions in the covered period to a defined benefit plan, they do count divided by 12. The question of whether they can be increased to assist in forgiveness is a tricky one. There are other rules that apply depending upon the overall limitation. And also don't forget about the 75%. So it could help you there. All right. So you've got to be careful. But yes, I think to the extent you meet the other requirements of the Internal Revenue Code, it could be increased. But again, there's overall limitation contribution limits, and you have to take those into account. That would be my response on retirement. What was the other question?
That was pretty much the question. Okay. Yeah.
Joe,
and another question
Amanda, hold on a second. Joe, you mentioned that the retirement payment, if you increase it in 2020, could help you with the 75-25%. So you're saying that the retirement payment to a defined benefit plan, for example, or you're suggesting that there may be a possibility that if it's increased, it would also increase your payroll cost because it comes into that formula of what constitutes payroll cost. Is that? I just wanted to clarify your answer.
Yes, that's exactly what I meant.
Terrific.
Yeah, and you're getting squeezed from all sides, though, so you have to maintain your head count as well, Henry. So if anybody's thinking about loading up their retirement plan, they may be suffering on head count with the payroll. So.
It's going to require some strategic thinking to maximize the forgiveness, but this is definitely an approach. Yes.
Correct.
One more question, and we're going to wrap it up. Amanda?
Yeah. So one of the questions we had was, what kind of tracking should you be doing in terms of where these funds are being spent? So either if it's for the PPP or if it's just for the $10,000 initial kind of grant for under the EIDL loan, do you need to keep the same kind of tracking and records for each? Do you keep tracking for everything? Do you have to open up a separate chart of accounts? How does that work?
I would answer that quick. We're recommending you open a separate bank account. So if you get a loan, PPP loan or an EIDL loan, I'd probably open two separate bank accounts so that you can clearly segregate the funds and keep track of them. So you're spending the correct spend in each account, and that'll make it easier for your accountant and to strategize from where you're spending your forgiveness money and whatever other funds have to be expended.
Tom, I've heard this from clients after we recommended opening up a separate account. They are concerned about going to banks and being able to open new accounts under the current stay-at-home executive orders, et cetera. Is it your experience that people were able to do it virtually?
Well, I would say that you could do it virtually. I don't have that experience yet. We haven't had any funding yet. So,
okay,
I don't know that issue. Yeah.
I
do want to say, Henry, want to say that documentation is going to be on the borrower's, if you will, onus, and I think documentation is going to be critical for purposes of forgiveness. So it is important that the spend be documented as best you can.
Wonderful, Tom and Joe. I think we are coming to an end of this webinar. I just wanted to thank the audience, the listeners, and the viewers. I wanted to thank Amanda and Jamie from Small and Marketing team for putting it together. Excellent job. And needless to say, my co-panelists, Tom and Joe. I'm sure we're going to be back, and as I suggested from the beginning of this webinar, please send us your questions that we haven't been able to answer in this short webinar. We'll do our best to respond to you in a timely fashion, and if you would like to get a copy of the PowerPoint presentation, we'll be happy to send it to you if you request it by email. Thank you very much, and please stay healthy and safe.
Stay well, everyone.